Every single year, I see people make the same mistakes. They rush to file their taxes, think they're done. And then few weeks later, they get that letter from the IRS. Why? Because they forgot one document. And that one missing piece can cost hundreds or even thousands in deductions and additional tax due. And I don't want that happen to you. So today I'm going to walk you through the 7 must-have documents before you hit file. Let's start with the basics, the income tax form. The first document is W-2 and 1099 forms. If you are an employee, you will get a W-2 form. If you are a contractor, freelancer, or business owner, you will get a 1099 NEC or 1099 miscellaneous. And here's why this matters. The IRS receives a copy of these forms directly from the employer or client. If you do not include one, the IRS thinks you are hiding income and automatically flags it. One of our clients came to us, he sells some merchandise, and he forgot to include just one 1099 for $50,000 of income. 6 months later, he received a letter from the IRS. The system had matched the income and found the missing form, and that's when the things got expensive. Here's the downside when this happens. The IRS doesn't just send a simple penalty notice. They send the bill for the full tax due, plus the interest, and then plus the penalties. In his case, the total tax bill was over $25,000. And here's the sad part. Out of that $50,000 in payment, his cost of the merchandise was about $30,000, plus other operating expenses. But the IRS doesn't know that. They assume the full $50,000 was pure profit because he never reported it. So now, instead of paying taxes on your actual income, you will be faced paying taxes on the whole amount. And that's a mistake that can easily cost you tens of thousands of dollars. Lesson learned? Even if the client or a vendor forgets to send you a 1099, you still need to include that income when you file your tax return. Because once the IRS catches it, it's too late to explain. And you will be paying tax on money you never really kept. So here's a tip for you. Double check all your income, not just your main job, side gigs, freelance projects. If someone sends you money through Zelle or Venmo for the work that you did, that counts too. If someone paid you more than $600, they're supposed to send you 1099. But honestly, not everyone does. Or they send it maybe late, or it might get lost in the mail. And here's the big mistakes people make. They think, well, I didn't get a 1099, so I don't need to report it. Wrong. This is how the IRS letters start showing up. At the end of the day, it's your job to keep track of every dollar that you earn. So set up a simple system. Use a separate bank account for business income. Keep a quick spreadsheet or use an app like QuickBooks and drop all your 1099s and receipts into one digital folder. Then tax season comes, you will become organized and totally audit proof. Now, if you are a medical professional or business owner, then this is for you. One of the most common mistakes I see. Let's say you get a payment from an insurance company on January 2nd, but they actually issued the check on December. Guess what? That means they were reported on the last year's 1099. Even though the money didn't hit your account until this year, if you or your accountant do not catch that, your income to totals won't match. And that's exactly how the IRS flags your return. The same thing happens with the businesses like pharmacy, insurance agency, daily stores, and many others that use systems like ProPay or other billing platforms that send 1099K form for the bill payment processing. If your practice also takes cash payments that do not make it into your records, this is where huge discrepancies show up. Remember that IRS now compares everything electronically. Your bank deposits, 1099s, and what you report on your return. Even a small mismatch can trigger an audit or a very uncomfortable letter in the mail. So when tax season comes around, don't just toss your income statements into a folder and hope your CPA will figure everything out. Take every 1099 you have received from insurance companies, payment processors, or even site consulting work and ask your CPA to double check the numbers. Here's another one, big one for the medical professionals. Pay close attention to who are the 1099s are issued to. This one is one of the biggest and most expensive mistakes I see. A lot of the doctors, they register with the insurance company using their personal social security number, but later start reporting income under their corporation EIN. So the insurance company issues the 1099 to the doctors personally. This mismatch creates a red flag for the IRS and can get costly very quickly. For example, one of the doctors came to us after receiving a notice for $180,000 income discrepancy. The insurance company reported payment under her social security number, but she had already claimed the same income under her corporation. The IRS thought it was an extra money and sent her a bill for nearly $90,000 in taxes. Lesson learned: always make sure your insurance contracts, payment setup, and tax filings are aligned. The payer name, taxpayer's ID, and way the income is reported must all match. If you're unsure, then have your CPA review it before e-filing. A simple 10-minute review can save you months of stress and $10,000s of dollars in taxes. Second document in your checklist, last year's tax return. This one is so underrated. Most people think, why does last year's return matter? I just need to file for this year. Your last year's return, it's your roadmap. Your CPA software uses to carry over unused credits, track depreciation to capital losses, and ensure consistency year over year. Just last week, we had a new client that came to us. Like always, my team asked for the last 3 years of the tax return. He looked at me and said, why do you need that? You're asking me for so many documents. We're filing for this year. Well, here's why. He had filed his first return with one accountant, the next year with another accountant, and now he came to us for the third year. When we reviewed everything side by side, we discovered something big. In his first year, he had a business loss of $88,000. The following year, he had a small loss, so no one noticed the error, and the loss was never carried forward. So this year, his income was $400,000, and that $88,000 loss could have saved him over $40,000 in taxes. Because no one checked his prior return, that money was just sitting there completely unused. So here's the lesson learned. Always bring your last 3 years of tax return to your CPA or advisors. It's not about curiosity, it's about strategy. We look for carryovers, missed deductions, depreciations, or credit. That can literally put tens of thousands of dollars back in your pocket. A 15-minute review can uncover mistakes worth more than a car. Here's the tip for you. Keep your last 3 years of income taxes organized. Why? Because IRS might ask for it, or they might even audit you and go 3 years back. So the third document in your checklist is the bank and investment statements. Now, this is where most people get confused. You typically receive 1099 interest, interest income from the banks, 1099 dividends, dividends from stocks or mutual funds, 1099B, sales or trades from the brokerage accounts. Even if it's $25 in interest, the IRS knows about it. They match electronically, so if you skip it, you will get a letter. Here's another example. One of the most common mistakes I see, especially with the new investors. They're thinking, I didn't make any money because I didn't cash out. I had a client who was trading on the Robinhood platform all year. By December 31st, most of his positions were down and he was losing money. So he figured there was nothing to report. He hadn't withdrawn a single dollar. But here's the thing. Every time you sell and then rebuy the stock, even though you don't take the money out of the account, it's still considered as a sale transaction. He had over $400,000 worth of trades and over 100 realized gains that he completely ignored. Few months later, the IRS sent a notice because Robinhood had already reported all those trades on his 1099B form. Once penalty and interest kicked in, that harmless activity turned into over $20,000 in additional tax bill. And here's the twist. If he would plan ahead, he could have used tax loss harvesting to turn that losses into wins. So how do you do this? Here's the tip for you. The tip number 1. Tax loss harvesting, you have investments sitting at a loss before year end. You can sell them intentionally to offset your gains. Those losses reduce your taxable income, and if your losses are larger than your gains, you can deduct up to $3,000 against regular income and carry the rest forward for the future year. Just make sure you avoid the wash sales rule, meaning you cannot rebuy the same stock within the 30 days. The key is to do this before December 31st, not after. This is how the smart investors use the strategies to save money before the end of the year. Second tip, watch your cost basis. Here's another big one most investors and even some accountants miss. Sometimes trading platforms do not report the cost basis of the stock you sold, especially if you bought it more than a year ago or transfer it from one brokerage account to another. That missing cost basis means the IRS thinks your entire sale was a profit. For example, one of our clients traded over $500,000 that year. On a few positions, his trading platform didn't include the original cost basis. On the paper, it showed over $200,000 in profit. But in reality, that wasn't true at all. If we hadn't reviewed his statement line by line, he would have been taxed on the entire amount. That could have costed him tens of thousands of dollars, even hundreds of thousands of dollars in unnecessary taxes. Always review your 1099-B and the brokerage statements before filing. Check that the cost basis is listed for every sale and that any transferred for long-term positions have accurate purchase date. If you're not sure, send all of the statements to your CPA before filing, because once the IRS sees the gain, they will assume it all taxable. Even if you didn't withdraw money, you are still responsible for reporting trades, gains, and losses. And with a little planning, those losses can actually save you money. Here's another tip for you. Do not forget crypto. Coinbase or any exchange now issue 1099 as well. Even one trade is reportable. Create a folder called Investments 2025 and upload every 1099 as soon as it arrives. So the fourth document on the checklist is the Mortgage Interest Form 1098. Homeowners, this one is huge. If you have a mortgage, you will get a 1098 form from the lender. It shows how much interest you paid, and that interest is tax deductible if you itemize. One of the new clients who came to us this year was homeowner from Miami. As we were preparing her tax return, I reviewed her prior year's return, and something immediately caught my attention. Last year, she had over $50,000 in mortgage deductions, but this year it only showed $10,000. That's a massive difference, and it didn't make sense. So I asked her, did you refinance your mortgage or switch lenders last year? And she said, yes, actually we refinanced it mid-year. And that was the issue, because she refinanced it, she had two different lenders in the same year. And each one issued a separate Form 1098. So the good thing, we always review prior year's tax return. So here's the tip for you. If you refinanced, sold homes, or switched lenders, you will likely receive two or more Forms 1098 for that year. Make sure your CPA includes all of them. Missing even one can cost you thousands or even $10,000s of dollars in deduction. Here's the lesson learned with our client. Always double check your documents, especially when there is a refinance. The IRS won't remind you that you forgot a deduction, and your accountant can only work with the documents that you provide to them. In this client's case, catching the missing form put over $7,000 back in her pocket, simply because we paid attention to the details. So here's another tip that I would like to share with you. Even if you didn't refinance, your lender might sell your mortgage during the year. Always check your mail or online statements for the multiple forms of 1098s. If you moved, changed lenders, or even switched to automatic payments, make sure you have every form before you file. The fifth document on your checklist, deductible expenses and records. This is where you can really save a lot of money if your records are clean and organized. Think about all the categories that could apply to you: medical bills, education or certification, charitable donations, and especially business expenses if you are self-employed or business owner. Now, here's the truth. The IRS doesn't ask for the receipts, then you file your taxes. They only ask for the proof if you ever get audited. But here's why keeping detailed records still matters, not for the IRS, but for you. If your bookkeeping isn't accurate or your numbers are incomplete, you will end up cheating yourself out of the deductions you are legally entitled to take. One of our clients came in last week. A business owner who was using his personal credit cards for business expenses. He said, "It's much easier, plus I get points and a higher credit limits." The problem, when everything is mixed together, groceries, gas, travel, business supplies, you cannot always clearly see what was the business expense that is deductible and what are the personal expenses. So when the tax time came, he had no clear breakdowns of what were the business expenses or what were the personal expenses and how to separate them. And ended up missing thousands in potential deductions simply because the records were not clear. Here's the tip for you. Keep your business and personal spendings completely separate. Use a dedicated business account and a business credit card and track your expenses in real time, not just once a year. You don't need to keep every paper receipt, but you do need a reliable system that shows what you spend, when you spend, and for what. That's how you maximize deductions confidently and protect yourself in case of an audit. Good records, it's not just about the compliance, it's about cash flow. The more organized you are, the more money you can keep in your pocket. The sixth document on your checklist, retirement contributions like 401k, IRA, SEP, defined benefit plan. Retirement plans are your built-in tax shelters. Every dollar you contribute lowers your taxable income, meaning you keep more money in your pocket and send less to the IRS. If you are self-employed, you have even more powerful tools available. You can open a SEP IRA or a solo 401k and deduct up to 25% of your net profit. For high-earning business owners, this is one of the smartest, most effective ways to build wealth and reduce taxes. Let me share an example with you. Last week, a new business owner came to us. His company made about $600,000 last year, and he paid over $250,000 in taxes. When we reviewed his tax return, I asked, "Did anyone talk to you about profit sharing or defined benefit plan?" And he said, "No, I only have simple 401k plan and I didn't know that I can even put more money." At this income level, he could have contributed up to $70,000 into profit sharing plan or even set up a defined benefit plan which could allow him to contribute $200,000 or even more per year depending on the age and the income. This one strategy alone could have cut his tax bill by tens of thousands of dollars and build a long-term wealth for retirement. Always talk to your CPA or advisors about retirement contributions. And if they're gonna tell you that it doesn't make sense, then it's probably time to change your CPA or advisors. You can usually contribute up until April 15 or with the extension till September 15 or October 15, depending on your entity structure. And if you plan ahead, you can often add more through SEP, profit sharing, or defined benefit plan. Retirement planning isn't just about saving for the future. It's a powerful tax strategy right now. The sooner you put these plans in place, the more wealth you can keep over time. The seventh document you cannot miss: health insurance forms 1095A, B, or C. If you purchase health insurance through the marketplace healthcare.gov, you will receive a form 1095A. This form is extremely important and it determines your premium tax credit, which can either give you a refund or create a tax bill if the numbers do not match. Here's another example I would like to share with you. One of our clients filed her taxes without including Form 1095A. The IRS automatically recalculated her return, and instead of giving her a refund, she ended up owing $2,500. But here's what actually caused it. And this is the mistake thousands of taxpayers make every year. When you apply for the marketplace insurance, you have to estimate your income for the upcoming year. If you enter a lower income, the system gives you a larger premium subsidy, which makes your monthly health insurance payments cheaper. The problem is, when you file your taxes, the IRS compares your actual income to what you reported on the marketplace application. If you earn more when you estimated, you have to repay it part or probably all of the premium credit. So let's say you told the marketplace your income would be $40,000, but your actual income ended up being $80,000. That difference can wipe out your entire subsidy, and now you owe the full cost of the health insurance for the year. For many people, that ends up thousands of dollars they weren't expecting. So here's the tip for you. Always wait until you receive your 1095-A before filing your return. Most of the forms arrive in early February, not January. If you are the marketplace coverage, review your income estimate annually and update if your earnings change throughout the year. The premium tax credit isn't free money. It's an advance payment based on your income. If your income rises, your subsidy shrinks, and if you don't report it, you will have to pay it all back as a tax during the tax time. Taking 5 minutes to review your 1095-A can literally save you thousands of dollars and a major headache later. Here's the difference between the average and the wealthy filers. They do not file early. They wait until all documents arrive. They use a document tracker, digital folder, which they label based on the tax year that they file. They plan ahead throughout the year, tracking deductions as they happen. And lastly, and most importantly, they meet with their tax strategies before the end of the year, not after. Because tax planning done in April, that's called the reporting. Tax planning done in November, that's called the strategy. Before you file your taxes, make sure you have these 7 must-have documents. The first documents are W-2 or 1099 forms, which report all of your income. The second document is the last year tax return, which carry over credits and losses. The third document is the bank and investment statements like 1099 interest, 1099 dividends, 1099-B. The fourth document is the mortgage interest, Form 1098, which allows you not to miss any deductions. The fifth document is the deductible expenses and records, which allows you to have clean books, which equal to bigger tax savings. The sixth document is the retirement contributions like 401k, IRA, SEP, defined benefit plan, which allows you to take a bigger deductions and taxes and then shuttle your taxes. And lastly, the seventh document is the health insurance forms, 1095-A, B, or C, which allows you to avoid costly surprises. Before you rush to file, take a deep breath and grab this checklist. Missing even one form can cost you thousands or maybe even hundreds of thousands of dollars. By staying organized, you can quietly build your wealth year after year. If you want a copy of this checklist, then click the link below. Because the financial freedom starts with being tax ready, not tax scared. And remember, financial freedom is all in your hands.